Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB this Tuesday afternoon. Great to have your company. Let's check in on where the local market is finishing the day's trade. Of course, we had that really good session yesterday coming after the big sell-off that we saw on Friday. And we've added to those gains. It looked a bit wobbly around 3 o'clock, but pretty flat there on the CBO 200. I will point out that the ASX 200 is looking brighter than that, up by about 0.2% as we head into the close. 17 points, 8,837 points, and really a big move coming through today from those tech players. Worth noting the financial stocks under a little bit of pressure. We're going to talk about the expectations of CBA with our guest Martin Crabb coming up. But let's get to the themes of the day. And it has been a bit of a tech flex after the tech wreck. We have seen some movement coming back into these tech players. The best performing sector is IT. Today up by some 2.3%. Worth noting healthcare, often defensive, but also of course we've got CSL tomorrow. It's up by about 1.5%. A lot of AI angst. We're going to talk about this with Martin Crabb as well. This is mainly in the insurance and the insurance broker sector on this new tool, Insurify, which has rattled some of the movement from the US insurance stocks. And you're seeing the likes of Steadfast, QBE here coming under pressure too. And back in the doldrums when it comes to our moods, a couple of surveys out today confirming what we pretty much already know. Last week's rate hike means that our sentiment has soured. The ANZ Roy Morgan survey, showing last week's decision has seen confidence hit its lowest level since December 2023. Those paying off their own homes are the least confident, no surprise. And the Westpac Melbourne Institute survey showing sentiment slip for a third month in February. So that rise in interest rates, the first one in 2 years, just adding to these cost of living pressures and making it harder for so many people to even get into the property market. Let's have a look at the sectors though, kicking it off with that run that we have seen coming through in some of these tech players. WiseTech, they're up by 2.4%, Xero, NextDC, Technology One, and Zip also looking solid. Having a look though at elsewhere in the insurance space, as we mentioned, this disruption once again coming through from AI. QBE down about 4%, IAG down 6%. It's going to report on Thursday, don't forget, and we'll be speaking to IAG as well. And AUB, they're down by 6%. And uranium, look, it is going nuclear, that pun intended. Boss Energy up by 11%, Paladin, Deep Yellow, Bannerman, Peninsula all lifting today and helping the overall materials sector, which is up by 0.8%. It is reporting season. We had a quarterly update from Macquarie Group, profit rising across its 4 business divisions over the December quarter. A really fab piece in the AFR as well about how Macquarie's kind of sticking it to the big 4 in terms of some of its growth as well, up by 1/3%. Westpac there down by 2%. It's searching for a new chief information officer. Current CIO Scott Collaro will retire later this year. Treasury Wine Estates, it had a good day, reaching a settlement with one of its US distributors over the closure of its California operations last September, but also saying because of that, it's now guiding earnings around $236 million, which is better than what it had previously forecast. PLS also doing well, inking a major supply deal with China's Canmax Technologies to supply spodumene concentrate over a 2-year period. And Region Group shares up 1%. First half net profit more than doubling. I spoke earlier to the Chief Financial Officer of that company as well as to how they managed to achieve that. You can catch that on ausbiz.com.au. All right, let's get into the nitty gritty with Martin Crabb from Shaw & Partners, who joins me on the desk. Great to see you, Martin.
Good to see you too.
A big week this week, really ramping up tomorrow. You were just telling me that the conference calls as well of CBA, CSL, all on at basically the same time. Yeah. CBA is obviously the big one. What are we expecting?
Yeah, it's a tricky one because this is one that disappointed in their last result, if you remember that. And look, everyone has high expectations of Matt Common and his team. They are considered by far the best bank, the best franchise, the best tech stack, the best, net interest margins, the best growth, etc. So they've really, with the PE they're trading on relative to the rest of the banks, they have to do well just to meet expectations. So I think the stock price has probably moved $10 higher in the past couple of weeks, just running into the result. So there's just a little bit of analysis we've done that just maybe asks a few questions. I don't know if we'll see this in the result tomorrow, but my colleague in Melbourne, Damien Williamson, who runs our income strategies team, he looks at the bank's term deposit rates. He just has a look every week, has a quick flick around the websites and talks to branch managers and stuff. And we just noticed that CBA is offering the highest term deposit rates across the majors, and that they've moved them up quite a lot since November last year. So yes, the cash rates moved higher by the RBA, but CBA's moved their rates significantly higher than the other banks. So I think once you go out into 3 and 4 years, I don't know if you've got the graphic there.
We do. We're just trying to get it up for you.
Sorry, I sent through quite a few charts, so I'm probably trying to find it amongst all of them.
There we go.
There you go. So you see on the 3, 4, 5 years, 2 years, the major bank term deposits, you can see CBA in yellow there, well above the competitors. So what we're seeing is that the CBA is fighting for and winning market share in deposits. So one of the other charts I sent through was just their share of deposits. So every month, Juliet, APRA puts out the statistics on all the approved depository taking institutions, of which obviously the banks are major. And it's showing a gain in market share pretty much since March last year in the deposit space. Now, for those who follow banks, mortgages tend to follow deposits. So if you're offering these attractive rates, if you're saving for a deposit, you go to the highest deposit bank. So it's natural when you go actually to buy a house and get your mortgage, you go to the same bank that you got your deposit with. So deposits lead mortgages. What we've seen is growth in their market share for deposits. We haven't seen growth in market share for mortgages. So you mentioned Macquarie earlier. Macquarie have been winning market share in mortgages. They've had some really competitive rates. So that's got potential negative implications for CBA's margins. They're paying up for deposits, but they're not getting the lending growth in the mortgage side. So basically that should put pressure on their net interest margins. Whether you see that tomorrow, I'm not sure. It may not have played through, but it's just something that investors should have in their back of the mind. Most investors we talk to have way too much Commonwealth Bank because it's been an incredibly successful investment. But it can be for the wrong reasons too big a part of your portfolio. So just people be a little bit wary of CBA. I'm not saying we'll see it tomorrow, but just more generally is that it is on a pretty big PE ratio relative to the other banks, and any sort of weakness in the result could see this share price off. Now I'm talking my book here because I don't own the stock in our portfolio, so I hope I'm right. But it's just something to be wary of. Yeah,
and it's so interesting, right? Because everyone's been saying for so long it's so overvalued. But I mean, what about even the fact that it kind of seems to be leading the way in tech and in AI? Do you think that's going to be something that Matt Common will be grilled on as well?
Yeah, I think so. Because how do you keep up? We'll probably talk about the insurance and Insurify and these apps. I mean, how does a big multi-billion or $100 billion company keep up with daily, weekly, monthly changes in models? I mean, you can't turn around your entire company. It's a big ship. I mean, for Commonwealth to even turn around its tech stack is multi years, if not decades, to do. So I think they're always going to be the incumbent. They're always going to have people chipping away. I mean, if I asked, in fact, I did ask a previous CEO, who's the biggest threat from you? And it was probably Visa, MasterCard, Zip, Apple. Apple was probably a bigger competitor than the other banks in their mind, because it's like it's just getting easier and easier to do things on your mobile phone, and more difficult to go into a branch, for example. So I think how much money do you want to spend to try and keep up with these apps that are being rolled out? It's quite tricky.
All right. Well, that segues nicely into what we're seeing in the insurance space. And that happened on Wall Street, that tumble. Just talk us through what we're seeing here. More disruption.
Yeah. So Insurify is an app that was launched, and it's doing auto insurance, as far as I'm concerned. I haven't had a chance to go and play with it before I came on air, but it allows one to search and get the best auto insurance deal. So that is a job typically that is done by a search site or a broker. If you look in the world of corporate reinsurance, so that might be insuring your staff or your building or your operations or your plant and equipment or your transport, that's incredibly complex, that whole area, and so you tend to use brokers for that. We have two big brokers in Australia, being Steadfast and Ausbrokers, AUB, and both we hit quite heavily. The biggest insurance broker in the world is Marsh & McLennan. So they're a big US company, and they are off over 7% last night, and that stock's been very, very weak, despite the fact that Wall Street's kind of ground higher in the past few months. Insurance stocks have really come under pressure. So it's another example of where someone's launched an app and you look at it and go, that is doing what I'm paying my broker to do. Not going to show up in today's results, Juliet, but it's more about over the longer term, can they maintain their margins? Can they maintain their market share? Will more and more people start using these apps to do day-to-day tasks? And does that hurt the franchise? Now, I think people sell first, ask questions later, and you can see that in the share price reaction today. I mean, for Steadfast to be down 10% of its value on the basis of one app does feel like an overstep, but that's the nervousness that market has about disruption.
Yeah, unfortunately, we don't have that Marshall McLennan chart that you provided, but that is quite the steep drop that we saw there, isn't it? The world's largest insurance broker. What chart we do have, though, I know, is what we're seeing in terms of total shareholder return. So it is reporting season, very much ramping up tomorrow. What are we seeing in terms of where our money's going? Yeah,
we're seeing analysts upgrading target prices. So I think some of this is due to the fact that most commodities are trading above analysts' expectations. You talked about uranium earlier. Everyone knows about gold and silver and copper. Most of these commodities are trading well above where analysts' forecasts have. So as we approach reporting season, they sharpen their pencil, they update their model, and they go, wow, gold at this price, Aussie dollar at this price, I need to up my earnings and my valuation, and that's what we've seen. So you can see that sharp spike on the black line on the right. That is market cap weighted target prices. So that's all the analysts, if you all got them in a room and they reached consensus on what the market was worth based on their individual company estimates, that's what you get. So the market in the red line tends to follow that, but not always. The grey line is just a 15% TSR level. It's a notional level where you go, the market's probably oversold. It's a 15% total shareholder return, including dividends. It does tend to go below that and then bounce. So there's a bit of a buy trigger. The important thing to note is that if that black line's heading up, the red line's going to follow it, right? So yes, sometimes target prices follow prices. Like analyst goes, my target price is too high. I'm at $1. The share's at 50 cents. I better reduce my target price. But generally speaking, prices follow targets. So what we're seeing so far, very early days on reporting season, as you know, Juliet, but as we go through reporting season, you might see some of those target prices being adjusted, some down, some up, but generally right now, the trend is up because the trend in earnings is up and share prices eventually follow earnings.
Do you think we're going to see some really big whacks like we saw last reporting season?
Unfortunately, yes. Yeah. I think if you miss even by a little bit, the market's just so impatient, particularly if there's any sort of cloud over your business model. Like if you're an insurance company and you come out with a miss in this market, based on what we saw today, it's just another reason to sell your stock. So the market generally doesn't need more than one reason to sell your stock, but if it gets two or three, i.e. you miss or your guidance is lower and there's any concern about your business model, that's a triple whammy. So we will see volatility. We've seen volatility even in big caps. Like that, was it Friday, Hub was off 15% or something. It's like, why is that business off 15%? So I think particularly if you're a growth stock and you've got a big PE, any miss on either current earnings or, more importantly, the outlook should see some volatility. It works both ways. Look at car sales, right? So car sales came out with an okay result. It wasn't brilliant, but the market was so nervous about the stock heading into the result that it's rallied 15% in 2 days. So unfortunately, I mean, some people like volatility. Some of your viewers might like to trade the volatility. For most of us, it's just, it just raises our blood pressure, right? And maybe not in a good way.
But it's also, Friday we're all losing our hair, like the biggest sell-off that we've seen since, April. And then yesterday's the best day since April. I mean, come on.
Welcome to the market.
Exactly. All right, well, I am chatting to Matt Common tomorrow. Any hot tips or questions you would really want to ask? I've obviously got my laundry list, but, this is one of the most, expected earnings of the season.
Yeah. Well, it's the biggest company in the market. It's 10% of the ASX 100. So it's the biggest game in town. I'm interested in what they're doing in the domestic market. Obviously, they seem to be aggressively chasing deposit share. I mean, what are they thinking there? Whether he actually gives you a straight answer on that, I don't know. But it's interesting. They're the biggest player. They've typically not got into a price war. They've just shed market share, but they now seem to be going, right, we're going to go more aggressive in pricing, and that's not a typical CommBank strategy. So I'd be interested to tease out what they're thinking on that front.
Yeah. All right, Martin, always a pleasure. Thank you so much for coming
Julia.
in. Martin Crabb from Shaw & Partners, giving us time in a busy reporting season. All right. We are still, of course, stock specific, and the stock of the day today was Macquarie Group. Andrew spoke to our experts, Philip Pepe from Shaw and Partners, Rudy Philippek Van Dyke from FN Arena.
Stock can get some real momentum, and if we are at the start of a 2 or 3 year bull market for capital markets transactions and commodities, this is the time to own this stock. So it's not as cheap as it was, say, even 3 months ago, but I would be comfortably holding this stock at the moment. In fact, I'll call it a buy because I think conditions for it are actually improving, and we got some, I mean, again, material increase on PCP across 3 of their businesses. Yeah. I think they can only improve from here, so I would be a buyer of Macquarie.
Maybe there's a trend here that maybe the tax rate might eat into some of the upside. Otherwise, I think the share price would be up a lot more. And I think on the basis of that, I think the upgrades from analysts will be quite modest, I think. But nevertheless, I'd be on board. I am on board, but I'd be on board anyway, because if the bull market continues, particularly for certain segments of the market, you have to have Macquarie in the portfolio.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN, retirement income done differently.
All right, well, it's pretty flat on the CBO 200, but as I mentioned on the ASX 200, we have managed to close about 0.2% higher. Let's have a look at some of the leaders that helped us get there, including Silex Systems. This was on a broker upgrade from Canaccord Genuity, as was Deep Yellow, but in general, we have seen quite a bit of buying in these uranium players today. Drone Shield also having a good day, up 6.3%, Superloop and Austal as well, firmer there. To the downside though, and this is pretty much what we're chatting about there with Martin, it really has been this disruption in the insurance space over AI. Steadfast is down by 9.4%, AUB is down by 6.2%, and we have also had IAG off by about 6%, and Suncorp down 4%, QBE down by 4%. My producers who never stop working just let me told me that Paul McKenzie from CSL has retired and Gordon Naylor has been appointed interim CEO. The small cap winners though, here we are: Pacific Edge up 40%, European Lithium up 21%, Calix, Peninsula Energy and Elixir Energy. And to the downside in the small end of town, G8 Education. Now this was on a flag of an impairment of around $350 million, so that saw its share price fall. Orion Minerals, Trek Metals, Bougainville Copper, also among the small cap laggards. Tonight, we are looking out for US retail sales, also US import and export prices, and earnings, of course, continues as well, those quarterly updates, Coca-Cola and Ford. And I should point out as well, James Hardie, which is, of course, dual listed, will be reporting as well, and we'll be following that and the effect, of course, on our market tomorrow. But earnings locally include those big ones we talked about: CBA, CSL, James Hardie, SGH and Dexus Industrial REIT. Now, it's going to be a very busy day here at Ausbiz, as it always is, but we will be speaking to the CBA CEO, Matt Comyn. We'll also be speaking to the SGH CEO, Ryan Stokes, and we'll be speaking to Dexus Industrial REIT as well, along with AGL, which is not up on that screen, but it's also coming through with its earnings tomorrow. We'll be speaking to the CFO. So just back to that news about CSL ahead of its earnings. Paul McKenzie has retired. Gordon Naylor has been appointed interim CEO. The CBO 200 there is very flat. The ASX 200 has closed firmer by, actually, you know what? It's just flipped as well. It closed down 3 points to 8,867 points. So unfortunately, the sellers got the upper hand just on the close there. And that is pretty much where we will leave it. I can give you a little bit more about what we're hearing from CSL. Dr. Paul McKenzie will retire as CEO and Managing Director. Gordon Naylor appointed. And the chair, Dr. Brian McNamee, has said that they would like to express their gratitude to Paul for his commitment and contributions to the company over the past 7 years, including his 3 years as CEO, and he guided CSL's global operations through the challenges of COVID-19. All right, a lot happening in reporting season, a lot to digest along with CSL's results and all those other ones we mentioned. We'll see you from 9:45 a.m. Eastern tomorrow.